morning, everybody. So excited to be here. Today we make history again. History of making history.
3 days ago, on June 12, 2026, a company that had never been public rang the opening bell on the Nasdaq. SpaceX, ticker SPCX. This IPO raised $75 billion in one shot, the largest initial public offering in history, more than 2.5 times the previous record holder, Saudi Aramco, which raised $29.4 billion. On its first day of trading, shares were priced at $135 and closed at $161, up 19%, putting the company's valuation at $1.77 trillion and vaulting it overnight into the 10 most valuable companies on Earth. But open up the financials, and last year it posted a net loss of $4.9 billion. A company that is still losing money. So what exactly let institutions oversubscribe and retail orders blow past $100 billion? In this episode, we're not going to tell you whether to buy. We're going to take apart 3 things: how that $1.77 trillion was actually calculated, what this company really makes its money on, and why the cash it raised is headed to space to build data centers. Start with that valuation, and how it managed to multiply 5-fold in just a year and a half. Wind the clock back. In December 2024, an insider stock sale valued SpaceX at $350 billion. By July 2025, a funding round pushed it to $400 billion. By December 2025, a secondary sale of insider shares jumped straight to roughly $800 billion, a doubling in 6 months. On April 1, 2026, the company filed confidentially to go public, and on June 12 it listed, with its pricing implying that $1.77 trillion valuation. 1 point worth flagging, because it's easy to be misled here. Those pre-IPO prices you may have seen, $185, $212, $421 a share, are old numbers from before a 5-for-1 stock split in early May. You have to divide them by 5 to compare them with the $135 IPO price. A 5-fold climb in 18 months is an abnormally steep curve, and it happened without a single public financial statement underneath it. So what the market is buying has never been the income statement as it stands today. It's a story about the next decade. The question is whether that story is really worth $1.77 trillion. Put this IPO into historical perspective and you start to see just how big it is. Raising $75 billion is 2.5 times Saudi Aramco's $29.4 billion back in 2019. It's more than the IPOs of Alibaba, Visa, and Facebook combined, with room to spare. This single deal accounts for about a third of the total raised by the 19 largest IPOs in history. Now look at the market cap. At $1.77 trillion, it sits nearly shoulder to shoulder with Saudi Aramco, the most profitable oil company on the planet, and with Tesla, landing it among the 10 largest public companies in the world. But here's the key catch. You can't value it on a price-to-earnings basis, because it's still losing money, with no positive earnings per share. So the market is using price-to-sales, and on last year's $18.7 billion in revenue, that ratio is a staggering 92x. Compare that with Nvidia at roughly 23x and Palantir at roughly 67x, and SpaceX looks astonishingly expensive. Morningstar has flat out called it overvalued, putting fair value at just $780 billion. In other words, within that $1.77 trillion, the business as it exists today is only a small slice. The rest is all priced in future. So what does it actually earn money on? Break open the 2025 financials, and SpaceX's total revenue was $18.7 billion, split into 3 pieces. The first is Starlink, its satellite internet business, which made up 61% of the total, $11.4 billion in revenue, with a positive operating profit of $4.4 billion and a margin of nearly 39%. This is the one engine in the entire company that is genuinely making money. The second piece is the core rocket launch business, $4.1 billion in revenue, but because Starship is still burning through R&D, it lost $660 million. The third piece is the most surprising. This past February, SpaceX folded in Musk's AI company, xAI, the parent of Grok. That unit brought in $3.2 billion in revenue last year but posted a massive loss of $6.4 billion. Add the three together, and the whole company lost $4.9 billion last year. Do you see it now? It's not that SpaceX can't make money. It's that everything Starlink earns gets burned up by the XAI business it absorbed. So this rocket company's income statement is really being held up by the 10,000 satellites overhead. Now look at just how strong that Starlink cash cow really is. As of March 2026, it had 10.3 million subscribers worldwide across 164 countries, with more than 10,400 satellites in orbit, over half of all the active satellites in the world. It has deliberately cut its monthly price, from $99 in 2023 down to $66 today, in order to grab price-sensitive new markets across Africa, Southeast Asia, and Latin America. Line up the competitors on the same chart and the gap is almost absurd. Amazon's Kuiper is only just beginning to deploy, trailing Starlink in satellite count by roughly 70-1. OneWeb has just 656 satellites, and it doesn't even serve ordinary consumers, only enterprises and telecom carriers. China's state-backed Guowang constellation is planned at over 10,000 satellites, but it's only just getting started. In other words, in low Earth orbit satellite internet, Starlink isn't merely ahead. It's ahead by a generation. And that is the hardest piece of bedrock under the $1.77 trillion valuation, a cash flow engine no rival can catch in the short term. The reason Starlink can blanket the sky so cheaply comes down to another business it dominates, rocket launch. Look at the 2025 numbers. SpaceX flew the Falcon 9 165 times, setting a record for the sixth straight year. And the rivals? United Launch Alliance, ULA, had planned 20 launches and managed only 6. Bezos's Blue Origin flew just twice. Add up the entire world, and SpaceX alone accounts for roughly half of all global launches and 85% of US launches. What's even more brutal is the cost. The Falcon 9 puts a kilogram into orbit for about $2,700, while the next generation Starship is targeting under $100 per kilogram, another full order of magnitude lower. Why does this matter so much to the IPO story? Because launch cost is the utility bill of the space business. When you can put things into orbit at a tenth of what anyone else pays, you unlock businesses no one else can afford. Laying down 10,000 satellites was only the first. The next thing Musk wants to send up there is AI data centers. So where does the $75 billion raised actually go? This is the most anticlimactic part of the entire prospectus. According to readings of the S-1 filing, roughly 78% of that money, nearly $60 billion, was in fact already spoken for before it was even raised, broadly split into 3 parts. One part buys back the stake of early shareholder Valor. One part repays the debt of the XAI business it absorbed. And one part goes to EchoStar, to complete a spectrum acquisition worth about $17 billion. In other words, the genuinely new money available to invest in growth is under $18 billion. But here's the interesting thing. Within that sub-$18 billion growth budget, the item ranked first in the S-1 is neither rockets nor Starlink. It's something that sounds like science fiction, orbital data centers. Musk wants to move AI computing into space. And this isn't just talk. The company has already applied to the FCC for licenses for up to 1 million orbital data center satellites. The rockets and the satellites have, in fact, become the tools for making that happen. Space-based AI data centers. What's the logic of this story? The first-generation satellite Musk has unveiled is called AI-1, with 120 kilowatts of continuous power per unit and a wingspan of about 70 meters, wider than a Boeing 747, with the first batch planned for launch in 2027. His vision math runs like this. Launch 1 million tons of satellites a year, each ton carrying 100 kilowatts of compute, and you add 100 gigawatts of new AI computing power every year, with no ground power grid and no cooling water. Why go to space? Because AI data centers on the ground are running into a wall. The International Energy Agency estimates global data center electricity use will double by 2030, surging to 945 terawatt-hours. U.S. power prices have already climbed nearly 40% over the past 4 years. AI data centers are projected to consume 600 billion gallons of water by 2030, and 2/3 of new projects are being built in regions that were already short of water. Moving the computing into space, running on 24-hour uninterrupted solar power, sounds like it neatly sidesteps all 3 of those ground-level bottlenecks. But is this a vision, or has it already been delivered? Here we have to be very honest and draw the line clearly. Start with the most counterintuitive point. A lot of people assume space is cold and easy to cool. It's actually the complete opposite. In a vacuum there's no air and no water, so waste heat can only be radiated away slowly, which is why that AI-1 satellite needs a massive 110 square meter radiator. Heat rejection is the real physical wall of space computing. Second, the economics haven't been proven. Even Google's own team estimates that for it to pencil out, launch costs would have to fall below $200 per kilogram before 2035. Third, the only players actually running AI in orbit right now are 2, StarCloud, backed by NVIDIA, which put an H-100 into orbit last year, and China's 3-body computing constellation, which has already launched AI satellites that are operational. As for SpaceX's AI-1 and Google's Suncatcher, both are still stuck at the 2027 planning stage. And by the way, even the 30% retail allocation this IPO originally promised got cut to around 20%, because institutions fought too hard for the shares. The vision is enormous, but the reality has to be read in stages. Let's recap today's 3 takeaways. First, with a $75 billion IPO, SpaceX set 2 records, the largest amount ever raised, and a $1.77 trillion valuation that sits shoulder to shoulder with Saudi Aramco, the most profitable company in the world. But remember, it still lost $4.9 billion last year. The market is buying the story, not the financials. Second, it has exactly one true profit engine, Starlink, 10,000 satellites and 10 million subscribers, propped up by its monopoly on low-cost rocket launch, carrying the entire company and absorbing the losses of the XAI business it took on. Third, 78% of the money raised is paying off old obligations. The real new bet is sending AI data centers into space, an enormous vision, but for now still just a 2027 plan, stuck behind 2 very real walls, heat rejection and launch cost. And here's a framework you can take with you. Don't ask whether you should buy the stock. Ask 3 questions. Can Starlink keep generating cash like this? Can Starship hit low cost with 0 failures? And will space-based AI actually arrive in 2027, or stay frozen as a rendering? The answers to those 3 will be more honest than any valuation figure. SpaceX isn't betting on the present. It's betting on Musk's next decade. If it were you, would you place that bet? Leave a comment and tell me your call. That's today's edition of the AI Ledger. I'll see you next time.